Belgium, long known as one of Europe's last strongholds of zero capital gains tax, is about to undergo a significant transformation. Starting in 2026, Belgium will introduce a 10% capital gains tax, ending its reign as a zero tax haven. This change marks a pivotal moment not just for Belgium, but potentially for tax policies across Europe. So what does this new tax framework entail? The Belgian government has laid out a comprehensive plan. Firstly, there will be a tax-free allowance of €10,000 annually, a relatively modest relief for investors. On gains exceeding this threshold, a flat rate of 10% will be applied. However, there are exemptions, particularly concerning the sale of businesses. If you hold more than a 10% stake in a company and your holdings exceed €1 million, you may be exempt from this tax. This new tax will apply to various types of investments, including stocks, cryptocurrencies, and business sales. The impact of this legislation is significant across different investment classes. For cryptocurrency traders, the new rules introduce new obligations. Every transaction between different cryptocurrencies will now be considered a taxable event. Similarly, converting your crypto holdings into euros or other fiat currencies will also fall under this tax regime. However, it's worth noting that unrealized gains and wallet-to-wallet transfers remain exempt from taxation. Stock market investors are also facing substantial changes. While the €10,000 allowance offers some relief, it pales in comparison for serious investors. If you make €1 million in gains, after the allowance, you'd owe around €99,000 in taxes. This is a considerable shift that could influence investment strategies and decision-making for both individual and institutional investors. On a more positive note, real estate investors in Belgium receive better treatment under the new tax framework. Primary residences will remain tax-free upon sale, and investment properties sold after 5 years of ownership will also escape capital gains tax. This protection ensures that the real estate sector remains an attractive investment avenue despite the broader tax changes. The Belgian government expects this measure to generate around €500 million in annual revenue. The tax primarily targets high-net-worth individuals and successful entrepreneurs, particularly those who benefit from short-term market movements. By focusing on these groups, the government aims to bolster its revenues without imposing excessive burdens on average citizens. With Belgium altering its tax policies, investors are now looking towards alternative tax-friendly jurisdictions. Many nations around the world offer attractive tax environments. In Europe, Switzerland stands out with its lump-sum taxation system and absence of capital gains tax. Despite higher living costs, Swiss residency can be worthwhile for substantial investors. Monaco also remains a pure tax haven, boasting a zero-tax environment with no income or capital gains tax, although entry barriers are quite high. Moving beyond Europe, the Middle East presents compelling opportunities. The United Arab Emirates, for instance, imposes zero capital gains tax and no crypto taxation, coupled with simple residency procedures, modern infrastructure, and a strong banking system. These factors make it an attractive destination for investors seeking to maintain tax efficiency. In Asia, Singapore shines with its zero capital gains tax policy, though the residency requirements can pose challenges. Malaysia offers tax benefits for foreign source income, and the Republic of Georgia provides straightforward options for cryptocurrency investors, making them appealing alternatives for those looking to minimize their tax liabilities. Looking ahead, Belgium's shift is indicative of broader changes sweeping across Europe. Similar to Norway's implementation of a wealth tax, this move suggests increasing pressure on traditional tax havens. While a 10% capital gains tax might seem modest initially, historical patterns indicate that such rates could gradually increase over time, further impacting investor behavior and international tax strategies. In conclusion, Belgium's introduction of a capital gains tax is more than just a local policy change. It reflects a shifting attitude toward investment taxation across Europe. While alternative jurisdictions with favorable tax regimes exist, evaluating these options thoroughly remains crucial for international investors seeking tax efficiency. Smart investors recognize these changes early and position themselves accordingly. Whether opting for established financial centers or exploring emerging opportunities, understanding global options is increasingly important in our interconnected world. The key lies in balancing tax efficiency with practical living considerations, ensuring sustainable long-term solutions rather than short-term fixes. As policies evolve, staying informed and adaptable will help preserve wealth while maintaining preferred lifestyles. Thank you for watching. If you found this video informative, please give it a thumbs up, subscribe to our channel, and hit the bell icon to stay updated on the latest developments in international finance, asset protection, and tax minimization.